Currency risk is one of the most important concepts in international finance. When businesses or investors engage in cross-border transactions, they face the possibility of financial loss due to changes in exchange rates. Understanding this risk is essential for anyone involved in global trade, international investments, or managing multinational operations. Throughout this video, you'll learn what currency risk is, why it matters, and how businesses protect themselves against it. Currency risk, also known as exchange rate risk, foreign exchange risk, or FX risk, refers to the potential for financial loss when exchange rates between currencies change unfavorably. Imagine a company expecting to receive payment in a foreign currency. If that currency weakens before the payment is received, the company will get less money when converted to their home currency. This uncertainty affects anyone dealing with multiple currencies, from small exporters to large multinational corporations. Currency risk comes in four main types. Transaction risk occurs when completing international transactions, such as buying or selling goods in foreign currency. Translation risk affects companies when consolidating financial statements from foreign subsidiaries into the parent company's reporting currency. Economic risk refers to the long-term impact of exchange rate changes on a company's market value and competitive position. Finally, contingent risk involves potential future obligations, like bids on foreign contracts or pending legal settlements in foreign currency. Each type requires different management strategies. Let's look at a practical example of transaction risk. A US company agrees to buy goods from a UK supplier for 100,000 British pounds. At the contract date, the exchange rate is £1 equals 1.30 US dollars, so the expected cost is $130,000. However, by the payment date 3 months later, the pound has strengthened to $1.35. Now the actual cost is $135,000. The company has lost $5,000 simply due to currency movement, even though the goods price in pounds stayed the same. Several key factors drive exchange rate movements. Interest rates play a crucial role. When a country raises its interest rates, it attracts foreign capital seeking higher returns, which strengthens the currency. Inflation affects purchasing power. Countries with lower inflation typically see their currency appreciate over time. Political stability matters significantly because stable governments attract investment and inspire confidence in the currency. Finally, economic performance, particularly strong GDP growth, increases demand for a country's currency as investors seek opportunities in growing economies. Businesses use various hedging tools to manage currency risk. Forward contracts allow companies to lock in an exchange rate today for a transaction occurring in the future, eliminating uncertainty. Currency options provide the right, but not the obligation, to exchange currencies at a predetermined rate, offering protection while maintaining flexibility. Currency swaps involve exchanging principal and interest payments in different currencies, useful for long-term financing. Natural hedging is a simpler approach where companies match foreign currency revenues with expenses in the same currency, creating a natural offset without financial instruments. Currency risk significantly impacts business operations in three main areas. First, profitability. Exchange rate fluctuations directly affect profit margins on international sales and purchases, potentially turning profitable deals into losses. Second, cash flow. Uncertainty in the timing and amount of foreign currency receipts and payments makes financial planning and budgeting much more challenging. Third, competitiveness. When a company's home currency strengthens, its products become more expensive in foreign markets, affecting pricing strategy and competitive position. Companies must carefully monitor and manage these impacts. To summarize, currency risk is an inherent part of international business that cannot be avoided but must be actively managed. The good news is that multiple hedging tools are available to protect against adverse exchange rate movements, from simple forward contracts to sophisticated derivative instruments. Most importantly, understanding your currency exposure helps companies make informed decisions about international operations, from pricing products to choosing suppliers to deciding which markets to enter. Effective currency risk management is not about eliminating risk entirely, but about understanding it and making strategic choices about which risks to hedge and which to accept.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.